welcome. You're watching Informed Investor, brought to you in association with the National Stock Exchange. I'm Sumera Abdi. Now, no discussion on India's banking sector is ever complete without a mention of India's largest public sector bank, the State Bank of India. So here we are at the headquarters in Mumbai, and before we can help their employees make better investment choices, let's...
If you look at the different options available today in the Indian financial space, banks are some of the best regulated. They have got very good regulation. They have a track record of very robust and stable performance. So they have the trust of the people. Now, banks also are able to give the whole gamut of financial services under one roof. And, so you can get insurance, you can get mutual funds, you can do transactions, and at very affordable rates, seamlessly and at low cost. So I think banks remain a great place to start the saving habit. For starters, we give an additional interest of 1% on deposits to staff. So that is an incentive for them to save over and above whatever would be the value proposition for saving. Then we also encourage our staff to take up courses like the Certified Insurance Facilitator or the AMFI, basically to make them investment literate. And the third thing is that we have very good insurance products which we also offer to them, both in terms of group insurance on the life side, the non-life side. So we encourage our staff to really espouse all these three things.
Alright, so we're all set to throw open the floor for the questions over here, but before we do that, let me introduce our two guests for the day. We have Mr. Tulsian and Mr. Hemant Rustagi, who are here to field any queries. But before we can get to the audience, I have a few questions of my own. Mr. Tulsian, I want to begin by asking you that, so often we hear, when we're advising people, we say, you should know if you're a long-term investor or you're a trader and never mistake the two. But even for stocks, there are stocks which are traders' favorites, and then there are stocks which, people say that you keep it for your retirement, just forget about it. How does a retail investor make that difference? How does he know which is a stock for him to hold on to?
See, actually, the traders never, considers any of the stocks for their long-term portfolio because they just look to the trend. Suppose take, for instance, now the bank stocks are doing well, they'll ride the bank stocks. Suppose tomorrow realty stocks start doing well, they will go for it. But if you really want to have the long-term portfolio, made for you, must go for the quality stocks. The only criteria I tell people that ask yourself whether this institution, this company will exist after 10 years. If he feels yes, that the company must have that kind of scale, that kind of brand equity, and you should ask yourself, even a layman can answer that can that company really grow for next 10 years? It doesn't matter whether it grows by the 2% or it goes by the 15%, 20%, CAGR, which we commonly talk. If it really exists in that fashion, and if it has a life or survival expectation that it can remain or it can be seen even after 10 years, one must add those companies in the portfolio. So the expectations of the existence, number one, and second is the management. So these are the two criteria for having in the portfolio of your long-term stocks, and the traders need to ride every day. Every day they have to look for the theme, they have to look for the momentum, they have to look for the sectors and account.
All right, so that's a good distinction to make, is to know that whether you're capable of devoting the kind of time that trading needs, or if you should be a long-term investor. But Hemant, this whole thing about having a long-term time horizon. If you're investing, there are a lot of schemes that these days that says that perhaps in 20 years you get 16 lakhs and 20 lakhs, and in absolute terms it sounds phenomenal. But if you look at the kind of investments that you're making monthly, the real return, or in terms of percentage, the kind of return that you get may not be that much. So how does a person, like you and me, or perhaps the people who've gathered here, know and calculate the kind of real returns that they should be expecting, and how they should go about making those investment choices?
See, in the products like this, the major attraction is, like you said, if someone says that after 15 years you're going to get 16 lakh or 20 lakh, that becomes a major attraction. The other attraction is obviously the guaranteed return. The problem is that most investors do not understand the concept of risk. See, there are two kinds of risk you have. One is the risk of basically losing your capital, and the second, which I believe is a bigger risk, is the risk of inflation. Most commonly investors focus on a risk of losing capital. That's where, even if they are getting 6% or 7% guaranteed return, they're attracted to that. But the fact remains that in the long term, you're investing for 15 years or 20 years, and if your post-tax return is going to be 6 or 7%, and considering that inflation will be at 7 or 8% on an average, your real rate of return, which is return minus inflation, is either zero or negative. So which means that you are, over the years, even though you kept the money for 15 or 20 years, the net result is nothing. It has just grown in numbers, not in terms of value. So I think it's very important to understand that when you're investing for the long term, the focus has to be on beating inflation. And that is where an asset class like equity comes into play. I know that many investors are not comfortable with equity as an asset class, but the fact remains that if you invest for 15, 20 years, have a diversified portfolio, select properly, you can get much better return than what you can get elsewhere.
Yeah, and we all work very hard at earning that money, so we need to make that money work for us also. But let's open the floor now. I believe you have a question, sir. Go ahead.
I have created a portfolio or selected the stock, 5 stocks: NTPC, SBI, RIL, L&T, and Tech Mahindra. Will it be appropriate to have a kind of 3 to 5 year horizon with a growth target of 28% CAGR?
As we have discussed, a while back, that you need to invest into the companies which exist for a very longer period of time. So if you really ask me, probably the sectors, which we need to choose is automobiles, tech, that is IT, infrastructure, and fourth is banking and finance. So I think you have chosen the right stocks. SBI falls in that category, Reliance Industries falls in that category, Tech Mahindra falls in that category. But I may not agree with the NTPC kind of stocks, because for the simple reason that there are so many what you call the strings attached with the company, that they cannot sell the power below this rate, the interference of the government, the capacity additions. They may not be able to work in the free environment. They cannot be able to compete with the other power generating companies in the same fashion. And that's the reason, if you really see the track record since the company went public, I don't think the record has been very phenomenal. So go for the value investing, choose the quality stocks, but need to tone down the expectations from the investments of all these kind of stocks, which has a longer term horizon. You can add one more company if you really want to ask me, could be the HDFC. And as I said, that automobile is missing from this list. You can add either Maruti and Mahindra, and look for a CAGR of maybe about 13 to 15%, which will be, since you have a time horizon of about 5 years, that kind of a return expectations can be made from all these stocks.
All right, so I hope that answers your question. We have another question that's waiting. Go ahead.
I have started investing in LIC's Jeevan Anand policy around 2 years back without getting into much details of the policy. Then at the time I was not having sufficient life cover. Now I am sufficiently covered by an online term insurance policy, and I think the returns which are obtained by LIC's this Jeevan Anand policy cannot be monitored on a regular basis and will be obtained after a very long time. So under these circumstances, whether should I continue investing in this policy or should I surrender it with some losses?
Well, as you mentioned, you've done the right thing by going for a term plan, which is the right thing to do, because the basic objective of taking an insurance should be the risk cover, and that comes primarily from a term plan. And the reason why is because the quantum of insurance is very, very important. When you go for a traditional plan like you mentioned about Jeevan Anand, one, you do not get the kind of insurance cover that you require. The second is the returns are very, very low, especially when you're investing for 15, 20 years. So now that you have a term plan, what you need to do is have a rethink on Jeevan Anand, because the best thing is that you establish your goals. For example, if you're investing for 15, 20 years, for what purpose, what is the objective of investing there? And if you have this kind of time horizon, I don't think Jeevan Anand is the right product for you. Only thing is, you need to see for how many years have you paid the premium, what is the surrender value for that, look at that. And I think if you separate your investment and insurance, which is what I think you've taken the first step there, look at something like a mutual fund. Invest in equity funds or balanced fund through systematic investment plan. I think as a combination, you will find that the amount of premium that you're paying for Jeevan Anand, with that premium, you are able to pay for your term plan as well as investing for SIP, and the results are going to be much, much better, especially because you have a time horizon of 15, 20 years.
All right, so on that note, let's take a very quick break. We'll be back in just a bit, but do keep watching Informed Investor. Welcome back. You're watching Informed Investor. During the course of our corporate campus visits, we visited a lot of companies, and this week we find ourselves at State Bank of India in Mumbai. With us are Mr. S.P. Tulsian and Mr. Hemant Rustagi, and a whole lot of SBI employees who are here asking questions and trying to get their investment objectives achieved. So we have a question that we can get to right away. Yes, go ahead. What's your question?
In recent years, Deccan Chronicles and KS Oil were in the news. because of these promoters have pledged their shares, and after that their news spread in the market and shares falls in the market. What type of security is available to an investor who has invested in these companies against promoters, sir?
See, firstly, having seen their activity, because I think for wrong reasons they are in the news, number one. Number two, I don't think that there is any way out for the existing investors but to wait. Take for instance, maybe the Deccan Chronicle. If somebody has bought at 100 plus, I don't think that there is any remedy except for him to wait, because the recovery proceedings, you being the banker, you all know that they have, in fact, at present there is no crystallized liability, that what kind of liability exists in the books of Deccan Chronicle, whether it is 3,500 crore, 5,000 crore. So it is very difficult. The corporate CDR has not been, recognized for this company. So I don't think that any investors, those who are not invested in these kind of stocks, whether you talk of KS Oil or you talk of Deccan Chronicle, I can name many of the stocks like this. So one should remain away. Even one should not even try to bother themselves that can I invest now at the current valuations, because they are very high risk stock. But many times these stocks even do attract the investors or so-called traders. So even if you want to do, maybe just throw 5% of your total investable funds into the stock market, and maybe you can just take a high risk, high investment kind of view on those stocks. Otherwise, my advice is that remain away. And for the existing investor, there is no other options but either to remain invested or cut the losses, which is indeed a very painful process.
All right, so I hope that answers your question, but we have a question on personal finance. Yes, sir.
What are the best risk-free investment avenues for retirement benefits other than bank deposits? And to what extent, percentage-wise, we can go for that investment, what you advise, other than bank deposits?
See, first thing what you need to do is to ascertain as to what kind of income you require on a regular basis. Now, if someone is getting pension, obviously, let's say the requirement is 50,000 rupees per month, and if the pension is around 20,000 or 25,000,
20% of 50,000.
Okay. Now we know that we need 30,000 per month. If I look at it on an annualized basis, I need basically roughly around 4 lakh rupees. Now it depends on the kind of corpus that you build over a period of time. If the corpus is of, let's say, 1 crore, then what you require is only 4%. Which means that you don't have to actually take a lot of risk. So it all depends on the kind of requirement you have. So first thing, look at your corpus, look at what your requirements are, based on that you decide. Now if there is someone who requires, let's say, return of 10% or 12%, because the needs on a regular basis are much more, which means that you have no option but to take some risk. But the risk has to be a little calculated and done in a proper manner, which means you can look at some hybrid options, like you have debt and equity, you have monthly income plans for mutual fund, which typically invest around 80% in debt and 20% in equity. Then you also have debt funds from mutual funds. You have short-term debt funds. What you can do is you can set up a systematic withdrawal plan. Okay, there is a facility in the mutual funds, depending on the kind of fund you invest in, which means that you can give standing instruction to the bank, to the mutual fund, to say that I would require this much money every month on this date. So automatically the money will be redeemed and the money will come to you. With this, you will make sure that there is no shortfall in your requirement. But like I said, the asset mix or the product mix will depend on what your requirements are. And if your requirements are like within reasonable limit, you don't have to necessarily take risk. By all means, you must ensure that you improve your post-tax return. You can do a mix of bank deposits. You can also do a mix of mutual funds. Invest some money in, hybrid kind of mutual fund that I mentioned. Do a mix of that and then work it out basically how much you need to invest in.
All right, so I hope that works for you. But we have one question on equity. Go ahead, sir.
Sir, what should be the long term for equity investment? Because Nifty is at same level after 5 years. In September 7 and September 12, it is almost at same level.
See, if you really...
5 years is not the long term?
No, if you really ask me, I'll say that minimum period of long term is 5 years. Income Tax Act defines 1 year. But I don't think that one should really look for a period of 5 years for calculation of the returns on the indices basis. If you are asking for the Nifty that, okay, in 2007 Nifty was X and today also the Nifty is same. But there may be many stocks, those who have given you a return of maybe 500% in the 5 year horizon. And some stocks may have given you a loss of about 80% in those 5 years. So either you calculate that on the Nifty or on an individual basis. So, but if you really ask me, firstly, because my experience of maybe close to about 35 years in the stock market, I say that you should be perpetual in the stock market, number one. Still, if you need to define some time horizon for the long term, it has to be minimum 5 years, because loosely we all have been, asking for the multi-bagger kind of stocks. For any multi-bagger, the minimum time horizon has to be 3 years. So it differs from each definition. If you ask from an income tax point of view, it is 1 year. From a multi-bagger concept, it has to be minimum 3 years. From the investment point of view of the long term and the quality stocks, it has to be minimum 5 years. So calculate the return on each stock instead of comparing it with the Nifty or with any other benchmark indices.
Well, on that note, we'll take a very quick break. Be back in a bit. Do stay with Informed Investor. Welcome back. You're watching Informed Investor, and this week we find ourselves at the State Bank of India campus in Mumbai. With us, Mr. S.P. Tulsin and Mr. Hemant Rustagi, and a whole host of SBI employees, and who are having their questions answered, and we hope they go away feeling more like informed investors. But we have a first question ready. Go ahead, sir.
See, what will happen to the Indian market if there is a downgrade happens, that is a sovereign downgrade happens, and why the retail investors in India are not able to understand the market condition? And for an example, actually a lot of redemptions are happening in the mutual funds when the market goes up. So what is the reason actually where we are erring, retail investors?
See, first wish that downgrading doesn't come for the country. If that really comes in, then we will not be seeing any kind of foreign investments in our country, because all the foreign investors, they are religiously or they are bound to follow the rating. They cannot invest into the company which has a junk status. So if that happens, we will not be having neither FDI nor FII. So obviously we all understand that what will be its implications. Then apart from that, even the trade becomes quite expensive. The currency becomes quite weak. So from all angles, you get caught. So I don't want to take that scenario, which is so scary, number one. Number two, it is right that the retail investors are in fact taking a contrarian view. Whenever they see the stocks moving up, they come and jump into the market. They start buying the stocks. In fact, I would say that they themselves need to be blamed for that, because they have become very impulsive. They ask for the targets. When you interact with the retail investors, I want to invest for 1 month. I want to have a return of maybe 10% in 1 month. You cannot really expect that kind of return from the market. Don't expect the magic from the market. Go for the quality stocks, have some time horizon. Always you can allocate, take out a small portion of your portfolio or corpus, which you can apply in these kind of high momentum kind of stocks on a frequent basis, or maybe at an interval, a regular interval whenever the market goes up. Otherwise, if you remain invested on a longer horizon, I think the equity market is the best. So ultimately, it is for the retail investors to take a call that they need to have some time horizon and they need to have some patience.
So we have time for just one more question. Go ahead, sir. What's your question?
Normally, it is perceived that the investment in mutual fund is safer than the investment in equity. Some 30 months back, I started investing through SIP in 4 mutual funds, which was perceived to be best in the market. Now, after 30 months, I found that whatever my investment was there, the principal was eroded. That I am not getting even 30,000 rupees. So it is not better to invest in recurring deposit, which is more safer and secured and having assured income.
When you invest through SIP, you're investing in an asset class which tends to be volatile. And why do you invest through SIP? Because you want to benefit from averaging. You want to follow a disciplined approach of investing. Now what we need to understand is we're talking about 2.5 years. Your average holding period is not even 2 years. Equity is not an asset class which is going to give you return. When you invest through SIP, even if you invest through SIP, it does not mean that you'll never see negative on the portfolio. What we need to realize is the more money we invest during the volatile period, the more we benefit from averaging over a longer period. Okay, now 2.5 years is not the time period when you start assessing basically the performance of an equity fund, even though they may be the best performing fund. You need to give it time. Don't forget that even if you do SIP of, let's say, for 10 years, your average holding period is only 5 years. So you need to give it more time. If you start looking at recurring deposit today, what happens? Yes, why it is looking good is because it gives you guaranteed return. You know that I'm getting 6%, 7% or 8%. But as we discussed earlier, how are you going to beat inflation with that? Equity as an asset class is going to give you better return, provided you have a long-term view. Keep investing in these funds. You have good quality funds. If you have made sure that you're invested in good fund, continue investing. 2.5 years is too short a period for you to really say that your funds are not performing. Like I said, your average holding period is not even 2 years.
All right, so thank you so much for being a part of our show, and thank you so much for taking the time out to be here. And thank you so much, Mr. Tulsi and Mr. Rustagi, for once again being on our show. Always a pleasure to have you. So on that note, we need to wrap up over here. Thank you so much for watching. Do keep sending us your questions and comments. And if you'd like to invite us to your corporate campus, you can also write into us. We'll see you here next weekend. Bye-bye.